Hey guys, this is Dawson Discussions, and my name is Nathan Dawson Jr. Today's date is May 9th, 2022. Today I will be reviewing this book, One Up on Wall Street, How to Use What You Know to Make Money in the Market by Peter Lynch with John Rothschild. So stay tuned. Okay, so Peter Lynch, who is this guy on the cover of this book. Peter Lynch, he is an American investor, a mutual fund manager, and a philanthropist. Essentially, he's a very big legend in the investing community because he was the manager of the Magellan Fund at Fidelity Investments between 1977 and 1990. So essentially, when he was investing in that, not investing in, but when he was managing that fund, the Magellan Fund, he averaged a 29.2% annual return, which was consistently more than double the S&P 500, which is the largest 500 companies on the U.S. stock exchange. And essentially, he made it the best performing mutual fund in the world at the time. So during his 13-year tenure, assets under management increased from $18 million to $14 billion. So he coined a number of well-known mantras of modern individual investing, such as invest in what you know and 10-bagger. Lynch has been described as a legend by the financial media for his performance record. So the story goes that in 1966, Peter Lynch was hired as an intern with Fidelity Investments, partly because he had been caddying for Fidelity's president, D. George Sullivan, and among others at Brayburn Country Club in Newton, Massachusetts. So a little bit about Fidelity. So Fidelity Investments Incorporated, a company known as just Fidelity, earlier before it was called Fidelity Management and Research, or FMR for short. It's actually an American multinational financial services corporation based in Boston, Massachusetts. So essentially, the company was established in 1946, shortly after World War II, and is one of the largest asset managers in the world with $4.5 trillion in assets under management, and is growing. The $4.5 trillion in assets under management was as of December 2021, and Fidelity Investments operates a brokerage firm which manages a large family of mutual funds to provide fund distribution and investment advice, retirement services, index funds, ETFs, wealth management for the uber wealthy, cryptocurrencies, securities execution and clearance, asset custody, and even life insurance. So in the year 1977, Peter Lynch, again, the guy on the cover, he was named to be head of the then obscure Magellan Fund, which is ticker symbol FMAGX, which had $18 million in assets. By the time Lynch had resigned as fund manager in 1990, the fund had grown to more than $14 billion in assets with more than 1,000 individual stock positions. Taking over when Magellan was a very small fund, Lynch had no restrictions whatsoever on what assets he could buy, except for the laws such as an SEC enforced federal law that prohibited him investing in company funds that are registered as diversified from holding more than 5% of total portfolio assets in a single company at the time of purchase. So essentially what he did was he focused on individual companies themselves rather than an overarching strategy, starting with larger U.S. companies and then gradually shift his emphasis to those smaller companies, and then eventually he took the fund overseas. So again, how I said earlier, from 1977 to 1990, the Magellan Fund averaged a 29.2% annual return. And as of 2003, it had the best 20-year return of any mutual fund ever. So Peter Lynch, he found success in a broad range of stocks from different industries. According to Beating the Street, which is Peter Lynch's second book, he said that his profitable picks were Fannie Mae, which is the Federal National Mortgage Association, Ford, the car company with the F-150 pickup truck, and the Ford Mustang. So, Ford is a very popular car company. Philip Morris, now it's called Altria Group, which is a cigarette company. MCI, which is the Microwave Communications Incorporated, which was a telecommunications company that was the largest telephone company right after AT&T, but later on it became acquired by Verizon. Volvo, a Swedish car company. the General Electric Company. General Public Utilities now is called First Energy Corp, which is an electric utility company headquartered in Akron, Ohio. The student loan marketing, I think you might know them as Sallie Mae. Kemper, which is an American insurance provider with corporate headquarters located in Chicago, Illinois, and Lowe's, which is the home improvement company. So essentially his most famous investment principle is to invest in what you know, popularizing the economic concept of local knowledge. Because since most people tend to be experts in certain fields, applying that basic invest in what you know principle helps individuals, investors to find good undervalued stocks. So essentially, Peter Lynch used that principle as a starting point for investors. He has also often said that the individual investor is potentially more than capable of making money in stocks than a mutual fund manager would, because they are able to pick good investments in their day-to-day lives before Wall Street was able to pick up on that company. So throughout his 2 classic investment primers, he has outlined many of the investments that he found while he was not in his office. So in the book, he said he invested in Dunkin' Donuts. Not after reading it about the company in the Wall Street Journal, but after being impressed by their coffee by being a customer. So assuming others would be similarly impressed and noting the company's Boston locations were always busy, Peter Lynch had then decided to study the company's financial status, and then he decided to invest in Dunkin' Donuts, which proved one of the best performing stocks he ever bought. Lynch believed that the individual investor is able to make a similar smart investing choices, noticing particular opportunities like Dunkin' Donuts, or paying close attention to business trends in their careers and hobbies. So Peter Lynch says it's easier because professional investors have to spend hours justifying their investment to their bosses and to their clients. Professional investors also have to own a lot of stocks, and they can't go 100% cash. But as an individual investor or a resale investor like you and I, you are not tied by the rules that professional money managers have to abide by. So essentially, a stock investor have to have patience, reliance, common sense, tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, willingness to do the independent research, willingness to admit your own mistakes, and ability to ignore general panic. That's a lot of qualities for that is required to be a retail investor. An investor must be comfortable making decisions without perfect information. History shows that humans are terrible stock market timers, but long-term investors become short-term investors when the market falls and sell for a huge loss. Okay, so chapter 1, the making of a stock picker, Peter Lynch's beginnings in this book. Already mentioned his beginnings. Moving on. Okay, chapter 2, the Wall Street oxymoron. Well, professional investing is an oxymoron. Professionals can't invest in a stock until respected analysts put the stock on their buy list. A stock is not attractive until some institutions have bought that stock. There is a street lag when it comes to owning stocks. Professional investors also have to spend hours justifying the investment to their bosses and their clients, because they also have to own a whole lot of stocks, and then they can't go 100% cash. Chapter 3, is it gambling or what? Well, stocks have returned more than bonds historically, and even today. When you own a stock, you're actually a partner in an expanding business. Peter Lynch has always famously said that stocks are not lottery tickets. It's actually part ownership in a publicly traded company. So when you invest in bonds, you're just a source of cash for someone, because you're actually lending money to an entity, because you have your governmental bonds. That's like me loaning money to Microsoft, Adobe, Intuit, Crocs, GoPro, Moderna, Pfizer, or Tesla, for example. For corporate bonds or government bonds would be treasury bonds, like to the U.S. Treasury for the U.S. government, the savings bonds, and municipal bonds for city and state governments, which are tax-free, by the way, in most cases. But at the same time, stocks are riskier than bonds, but the risk can be mitigated by investing appropriately. So chapter 4 is passing the mirror test. So if you need the money in a couple of years, it's not wise for you to invest in the stock market because of the fluctuations for obvious reasons. Even those blue chip stocks like companies like Apple, Amazon, Coca-Cola, Pepsi, Walt Disney, they can actually go down into a 3-year time frame. So you want to invest in those stocks only invest in money that you can afford to lose without it having to affect you on a daily basis. So again, going back, you need to have the patience, self-reliance, common sense, tolerance for pain, open-mindedness, persistence, humility, flexibility, willingness to do independent research, and all that other good stuff in order to be a successful stock investor. Chapter 5, it is a good market. Please don't ask. So people are always interested in whether the stock market is good at the moment, but that's not an easy question to answer. Economists work very hard to predict a recession, which is a severe economic downturn that the GDP has been growing for the last few quarters. But they can't seem to get it correct twice in a row. Experts studying stock charts, put-call ratios, Fed policy, and foreign investments can't really predict markets with any useful consistency. You want to focus on the businesses, not the general market. You want to pick the right stocks. If it is an overvalued market, you will not find a single company to invest in because none of those stocks will be reasonably priced. Chapter 6, stalking the 10-bagger. 10-bagger essentially returns amounting to 10 times your original investment. Borrowed the term from baseball, where additional base hits are also referred to as baggers. The best place to find a 10-bagger is closer than you think. It's in your backyard, your shopping mall, where you work. Being in the business gives you, the average stock picker, a huge advantage to pick winners from small, fast-growing companies as compared to Wall Street, which is always get the news late. Chapter 7, I've got it. Well, what is it? The size of the company has a lot to do with what kind of returns you can get. Big companies are stable, but they don't make huge moves. On the other hand, smaller companies can make those gigantic moves in a short amount of time. All else being equal, you would do better with small companies if you want that major growth. Okay, what are the categories of stocks that Peter Lynch classified though? Well, one, you have your slow grower. These are your large, old, yet well-established companies that are slower growers, but they grow slow. They grow slightly faster than a gross national product. They start out as small and fast, and eventually they got big, old, and then they just got tired. When the industry slows down, most of the companies within the industry is probably going to slow down as well. Sooner or later, every popular small and fast company will become slow growing. The characteristics are: one, they will rarely yield a big return on investment because they're so large. Two, these can be identified by a low trajectory of earnings growth and sales growth. Three, they're known to provide regular and hefty dividends. And four, typically they do well during recessions because they're so large and they have a whole lot of money that they usually sit on. Examples would be a utility company. Here, YL. Currently in coastal Virginia. There's a utility company that I'm a customer of, which is called Dominion Energy, ticker symbol D. It's actually an American energy company headquartered here in Richmond, Virginia. Well, in the state of Richmond, Virginia. I'm not personally physically in Virginia. I'm actually in Norfolk, Virginia, but here, or relatively speaking, Richmond, Virginia, that supplies electricity in parts of Virginia, North Carolina, and South Carolina, and supplies natural gas to parts of Utah, West Virginia, Ohio, Pennsylvania, North Carolina, South Carolina, and Georgia. Dominion also have generation facilities in Indiana, Illinois, Connecticut, and Rhode Island. Peter Lynch personally don't like this type of stock classification, as the stock really isn't growing and expanding at fast rates. So to him, it's kind of boring. He do own a few, but he don't really pay much mind to this classification. Again, the slow growers. Number 2, the stalwarts. These are also large companies with strong fundamentals, making them very resilient to economic uncertainties. Despite their modest profit growth of at least 10%, they are well-known and respectable companies in the eyes of the public, are relatively low risk, and can quickly recover from a recession. Typically, it's a big market capitalization. Earnings per share grow steadily at a rate slightly above that of the market, and they might have a low debt to equity ratio. Examples would be today, I would say Procter and Gamble, Five Below, Ulta Beauty, Columbia Sportswear, Foot Locker, Moderna, T. Rowe Price, Adobe, and Intuit. Number 3, you have your fast growers. These companies may not be as large or fundamentally as strong as the other two, but they have a potential to grow at least 15 to 20% or even higher each year. Some of them can produce a return of 100 to 200% in just a few years, but such growth should be driven by revenues and profits generated by business expansion, not by buying and selling assets. One advantage of investing in these stocks is that you can hold them for as long as they can keep their growth rates up. Typical examples of fast growth would be high and consistent price to earnings ratio and earnings per share growth at a rate of 15 to 20%. And even if you're lucky, maybe a very specific competitive advantage like a intangible asset like a patent, copyright, trademark. If it have a network effect, superior pricing power, or also a high switching cost, which is going to be very difficult for like they have this ecosystem, and it's going to be very hard for somebody to get out of that ecosystem and switch into a different company. For example, Google, prime example. If you have a Google account, chances are you might have a Gmail, you might have Google Drive, you might have Google Pics, Google Pictures. You might use Google Maps for navigation, or you might even use Waze. I use some of those products, but the likelihood of me trying to switch from all that, or at least trying to switch to a different company that offers those services, is kind of slim because the brand name, the reliability, and the anguish I'm probably going to have switching over, because it's going to be a big inconvenience. And also another example is if you have an iPhone from Apple, chances are you might have Apple TV account, an iPod, an iPad. You might use iTunes. You might have data on the iCloud. Now, for you to take all of that and then switch some of your stuff over to Samsung or Microsoft, then it's going to be very inconvenient for you to actually do all that. Retracing my steps back to network effect. Network effect would be like Meta. You might know Meta as Facebook. So Facebook app all by itself is not useful. But if everybody were to start using it, then it would be valuable, because in order for you to keep in contact with somebody on social media, you would probably use Facebook. Twitter kind of sort of operates the same way. I don't really understand Twitter's business model. I mean, I know it's social media, but I understand Facebook's business model a little bit more because I use Facebook more. Also, for network effects, same with Visa and MasterCard. Everybody mostly use Visa and MasterCards for their debit and credit cards, and the main reason why is because merchants accept them because we use them. So it's that network effect. Same thing with Uber also have that network effect, at least that market of drivers. So the more people who need transportation, there's gonna be a demand for Uber drivers, and Uber drivers, they're gonna still be in business because people, they need transportation, because you have that giant network of drivers and passengers. And also tracing my setbacks again, going back to intangible assets like a brand. When you think soda, you probably think Coca-Cola because of the branding. When you think cell phone, you think Apple because of iPhone. When you think search, you think Google. So with that branding, even though that the brand itself have a very good reputation, you're more likely to spend a higher premium on the brand itself than something that's off-brand, even though that the off-brand is probably similar to the same product. But like if you trying to buy like like a generic cornflakes cereal or generic Frosted Flakes, but you will probably want to stick with the regular Frosted Flakes with Tony the Tiger, even though that the generic is cheaper, but you're still going to pay that premium because you're more familiar with Kellogg's and you actually like that brand. Trademarks, a certain slogan to identify your business from another business, so on like that. So examples of fast growers, how I see it, is Crocs, the shoe company, Block, formerly called Square, Square as Cash App. I think C3AI, I think that's a fast grower. Abercrombie and Finch, which is a clothing company, and GoPro, which is a camera company. Okay, moving on. 4. You have your cyclicals. Cyclical stocks are companies whose sales and profits rise and fall in more or less in a predictable fashion based off the business cycle of the economy. They go through episodes of expansion and contraction as their ability to generate profits are highly sensitive to certain external factors. Most are related to oil, petrochemical, coal, commodities, agricultural products, and even real estate. With cyclicals, the price and earnings ratio and earnings per share tend to follow patterns of peak and plunges. 3 years of profitability and 2 years of losses, for example. So before you invest in these, make sure you really understand the business cycle, including the cycle resources needed to operate the business. Otherwise, you can actually buy into the wrong part of the cycle and then sell at the wrong part of the cycle. So example of cyclicals would be Ford, because it's a car company. So of course, when you think when the economy is booming, people are a little bit more likely to buy new cars. If the economy is slumping or slowing down, people are not likely to buy a new car. Carnival Corps with the cruise lines operate in a similar fashion. If the economy is booming, people make a whole lot of money. More confidence in the economy, people that want to go travel. GM, another car company. Delta Airlines, same thing. Cyclical. That usually during the summer it peaks, and then flights, the price of flights will go up. But with the health crisis that we had early in the decade, like a few years ago, kind of made it a little bit more difficult because for obvious reasons, supply and demand, like that. Okay, number 5, you have your turnarounds. A little bit hard to explain, but these are the companies that have suffered severe losses, or they nearly went bankrupt due to unprofitable investments and ventures, or just a lack of liquidity. But they are in the process of turning themselves around, hence the name turnarounds. If these companies repay their debts or successfully restructure their businesses and turn a profit, you can actually benefit from that too. So essentially, the PE ratio and earnings per share follows a pattern of peak and plunges. Net profit becomes positive, debt to equity ratio continues to fall. So this is a very highly risky investment, as they could go bankrupt anytime. And then when they go bankrupt, then the share price goes down. But even though if the share price do go down, you don't want to buy into it when it's when they are about to turn around. You want to do it when they are turning around, and then when it turn around, then the price goes up. And lastly, number 6, asset plays. These companies usually own high value assets such as real estate or shares in other companies like Berkshire Hathaway, which is Warren Buffett's holding company that owns shares in a number of different businesses. So if you put your money in an asset play, if they invest in profitable business or in prime real estate, the value of the asset play company will also increase as well. That means you have a chance to enjoy a huge capital gain when the market realizes the real value of the asset that the company is holding. So searching for asset plays really won't require much ratio analysis, but you have to dig quantitatively through the company's financials. Well, quantitatively through the company's financials to see what assets are they holding, how much did they spend to acquire those assets, and how much more of those, and how much are those assets are worth today. You can find information in public statements released by the companies. So no one really knows when a market will realize the real value of those asset-placed companies, especially those that own real estate. That might prevent their stock prices from going up for quite some time. Examples would be Walt Disney. Now, when you think Walt Disney today, you do think of the streaming service, but before streaming was a thing, they had land. How so? Disneyland. Now with that, they also have a TV channel, which was the Disney Channel. Another example would be Pfizer, because Pfizer, they have all these patents of drugs. Because, if you have like a whole lot of patents, because these patents will probably won't show up on the financial statements like that. Okay, chapter 8, the perfect stock. What a deal. If you have to choose between a great company with excellent management in a competitive and complex industry, or a so-so company with mediocre management in a simple industry with no competition, you want to go with the latter, the so-so company. So the reason why is because Lynch, he likes, if the company is dull, or even better, it sounds ridiculous. Companies with names like Automatic Data Processing or Pep Boys, Manny, Mo, and Jack are boring, but the business and stock are going up. You also like it if the company does something dull or boring, like Crown Cork and Seal, which was a company that makes bottle caps. Professional investors stay away from those boring businesses until some big news comes out. Then the stocks become trendy and overpriced, and then it's going to be time for you to sell. It does something that's agreeable. These companies are not just boring, they also are disgusting in a way. But they grow their earnings every quarter and their stock follows suit. Like, I'm guessing an example would be the military defense contracting industry. War, that's agreeable, but all these companies, they're very profitable, and then they haven't been going bankrupt. I think also another example would be Altria Group, because, cigarettes. And, cigarettes, bad health. Altria Group is still around, and they pay a high dividend, if I'm not mistaken. It's also a spinoff. Companies don't want spinoffs to get in trouble, because that would bring bad publicity. Hence, spinoffs have strong balance sheets and are prone to be successful as those independent companies. Institutions don't own it. Analysts don't follow it. These stocks were not followed by analysts at all, or they were once popular, but analysts have long abandoned them. There's rumors behind it. It's involved with toxic waste and or the mafia. Despite being an industry that almost everyone despises, waste management was up 100-fold. So Lynch prefers those kinds of industries and those companies. There's something depressing about it. Service Corps International, ticker symbol SCI, is in the funeral homes business. Again, something people don't like to think about or ignore. The company was ignored by institutional investors for years. It's in a no-growth industry. Everyone wants to invest in those high-growth, trendy industries, but there are great opportunities in no-growth industries also, where there is very little competition. Because, the very nature of capitalism is competition. The less competition you have, the more likely you will succeed. The more competition you have, the less likely you are to succeed. Unless you have a competitive advantage. Warren Buffett's term will be an economic moat, just like how I said with the intangible assets, network effect, high switching costs, or superior pricing power. And superior pricing power would be like, Walmart. They buy all these things, then they sell it at a discount. Yeah, I think that's how the superior pricing power actually works. Also, Peter Lynch likes it if it have a niche. There's a lot of value in exclusive franchises to a company. Once you have an exclusive franchise, you can actually raise prices, and the stock prices tend to follow. Drug companies benefit from products that no one is allowed to make. People have to keep buying it. I think, medicine, sodas, food, shaving blades, razor blades. People need to keep buying them, and the companies that make them stick around for a long time. Those high sales. It uses technology. Of course, back in the day, Peter Lynch, technology really wasn't a thing, but now today, technology is a thing now. Companies like ADP that benefit from cheaper computing are able to increase their profits. The insiders are buying. The insiders have the best information. Anytime an insider buys a stock, it means that they think that the stock is undervalued, and then chances are the stock price is going to go up because of, supply and demand. And lastly, the company is buying back shares. Again, supply and demand. When a company buys back its shares, it reduces the share count and earnings price per share goes up. This in turn causes the stock price to go up, which is a good thing. Okay, chapter 9, the stocks that Peter Lynch would avoid. He would avoid the stock in the hottest the hottest stock in the hottest industry. These stocks tend to go up fast, they get a whole lot of publicity, but eventually they're going to fizzle out. So you want to be aware of companies that are going to be the next Intel, the next Google, the next Disney, the next Uber, the next Netflix, the next Amazon, the next Tesla, the next Meta, Facebook, so on and so forth. You also want to avoid diversification. It's a term, diversification, but diversification means you make yourself even worse by doing all these bad things, bad being subjective. But anyway, the process of adding investments to a portfolio in a way that the risk-return trade-off is worsened. Diversification occurs from investing in too many assets with similar correlations that add unnecessary risk to a portfolio without the benefit of higher returns. So, people say you want to be diversified, but if you do it too much, your risk-return trade-off is worsened, or if you're highly concentrated in one sector, but that sector goes down, even though they have many of those stocks, because stocks in the same sector, they typically move in the same fashion, kind of, sort of. You also have the whisper stock. Investments in a whisper stock can be highly speculative because the rumor may turn out to be false. Furthermore, if one knows the rumor to be true for a fact and buys or sells the whisper stock accordingly. Okay, moving on. Chapter 10, earnings. Earnings are what makes the company very valuable. Price to earnings ratio, or the PE ratio, is a useful measure to check whether a stock is overpriced, really priced, or underpriced. There are 5 ways a company can increase its earnings: reduce costs, raise prices, expand into new markets, sell more of its goods and services, sell money losing operations. Analyzing how a company can improve its earnings will help you develop a story about the company. So Chapter 11 is a 2-minute drill. Before you invest in any stock, give yourself a 2-minute monologue about the story of the stock. If it doesn't matter which of the 6 categories it falls in: slow grower, stalwart, fast grower, asset play, turnaround, or cyclical. If it's a fast growing company, then you have to ask yourself how the company is continuing to grow. So again, it doesn't matter which company, slow grower, stalwart, fast grower, cyclical, asset play, or what's the other company? Slow grower, stalwart, fast grower, cyclical, asset play, and turnaround. Because turnaround, I don't really deal with turnarounds that much, because that's probably why I forgot about it. Yeah. Also, Chapter 12, get into the facts. One area where professional investors have an advantage is being able to talk to the companies directly. Amateur investors like myself, or retail investors like me and you, can't call up on the CEO and ask questions, but we can actually use the broker to get information on a company. So, you just have to go to the investor website of investor relations on the company website and then just read through the reports. Chapter 13, the famous numbers. You want to check the percent of sales. If a company has an exciting product, check the percentage of sales for that product and the product line. Price to earning ratio. Half the growth rate is positive. PE is twice that of the growth. PE ratio that is twice the growth rate is negative. More cash on the balance sheet, the better. Debt, pay attention to the debt and a debt structure. Hopefully that they're not taking on too much debt, but you want that debt to actually be paid off over time. The book value, don't just look at the book value, but actually understand what the values are. What a company counts as assets may not be worth that much. Cash flow, free cash flow is whatever left over after normal capital spending. A company having modest earnings but excellent free cash flow, I think that's a good deal. Inventories, check the balance sheet to check if inventories are piling up. It may be a red flag. Pension plan. Today companies, they don't really do pensions anymore, but book came out in 1989. A company must pay its obligation even if it goes bankrupt. Dividends cushions the company from failing too much. The growth rate, 20% plus growth rate to be a multi-bagger. So essentially, for long-term holdings, the company must have a high profit margin. And Warren Buffett, he preferred for the gross profit margin to be at least 40%, but the net profit margin must be at least 20% for him. Chapter 14, recheck the story. After you have identified a stock, it is important for you to revisit the story to confirm it is still valid. Read the quarterly reports and research the company to check whether its earnings are holding up as expected. A company goes through the 3 phases: startup phase, rapid expansion, and mature. Each phase may last several years, and the rapid expansion phase is where most of the money is made. In the mature phase, the company runs into limitations. Chapter 15, the final checklist. So, what you actually want to look for when you're trying to put everything all together. The PE ratio, is it high or low relative to its peers in the industry? You want it to be lower. Percentage of institutional ownership. Insiders are buying. The company is buying back its shares, earning gross cash position, and not a lot of debt. Debt to equity ratio is low. For stocks in general, if you follow those those pointers that Peter Lynch says, you'll probably do well in the stock market. Now, more specifically, slow growers, you want to see, are the dividends safe? What percentage of earnings are paid as dividends? You want to have a low payout ratio. I think it's less than 50%. Anything higher than that, the company is in danger, or you're in danger of having your dividend cut, because they probably don't have a whole lot of things to do with the dividend, and then with their earnings, and they have to get over dividends, high dividend yield, typically a bad thing, and then something bad is probably going to happen. So you have to check the balance sheet to make sure that it actually makes sense. Also, is the company raising the dividend on an annual basis? Because it'll let you know that the company is profitable, because they can't give you a dividend if the company isn't that profitable. And all of that is also to prevent your buying power from eroding because of inflation. Stalwarts. Check to see how long the long-term growth rate of the company is doing. How well did the company navigate during the previous recession or economic downturn? Check the price. The PE will tell you if you are paying too much. For the cyclicals, to watch out for your inventory levels and the supply-demand relationship. Anticipate a shrinking PE as companies as business recovers and investors look forward to the next cycle. If you're industry intelligent, then you can actually figure out that cycle. Fast growers, 20 to 25% earnings growth is preferable. Is the company able to replicate its success in more than one city or area? Does the company still have room to grow? Is the stock PE ratio at or near its growth rate, which is actually a good sign? If only a few institutions hold it, it's also a good sign, because the stock is likely to go up in the future. Again, supply and demand. For turnarounds, what is the company's debt position? Can the company survive, or will the debt holders take over the company? Are costs being cut? Can the business actually come back? And lastly, asset plays. What is the value of the assets? Is the debt manageable? Is it being paid off? Is a corporate rate or activist investor involved to help shareholders benefit from an increase in share prices? Chapter 16, designing a portfolio. An average investor can design a portfolio to generate a 12% to 50% return. A small portfolio can own between 3 and 10 stocks. Spread your money between different categories of stocks to minimize your risk. Younger investors have more years to make mistakes and find great stocks. Portfolio design changes as you get older. Chapter 17, when is the best time to sell? The best time to sell a stock is around the end of the year. Tax lock selling and institutions clean up their portfolio, as in selling their laggards, drive stock prices down and allow patient investors to pick up bargains. Some general sell points. Company announces massive share issuance. You want to sell. Sell the business units, bring in less cash than expected. You want to sell. Reduction in corporate taxes. Consider reduce the company's tax loss carry forwards. You want to sell. Institutional ownership has grown and reaches 60%. You want to sell. So for slow growers, Peter Lynch really don't have a whole lot to say about this one, but the company has lost market share for 2 consecutive years, no new products, it acquires unrelated businesses and overpays for them. Stalwarts, the PE ratio is too high. New products have mixed results. No insiders buying. The company is not buying back their shares. Major division is vulnerable, and the growth rate is actually slowing down. For the cyclicals, sell at the end of the cycle if you can actually predict it. Cost rising and plants operating at full capacity. Competition is heating up, especially from foreign companies. Demand is slowing down. For your fast growers, he said that the trick here is not to lose your multi-bagger, but if you really have to sell, then the end of the expansion phase, the top executives join a rival firm. The high PE decreasing growth rate, sales are slowing down, and they're slowing down or curtailing research and development spending if it's a very small company. For your turnarounds after a successful turnaround, obviously, debt has declined, inventories are rising, and the PE is inflated relative to the expected earnings. Asset plays. Is there a corporate raider in its wings? Essentially, a corporate raider is an investor who buys a large number of shares in a corporation whose assets appear to be undervalued. The large share purchase will give the corporate raider significant voting rights, which could then be used to push changes in the company's leadership and management. This would increase share value and thus generate a massive return for the raider. Institutional ownership hit 60%, and that's it. Institutional ownership hit 60%. Okay, last chapter, chapter 18, the 12 silliest and probably the most dangerous things people say about stock prices. Okay, it's gone down this much already. It can't go down further. Well, there's generally no rule for how low a stock can go. The best advice that he can give is, if you can catch yourself saying this, time for you to get out. You can always tell if a stock hits a rock bottom. Nobody knows when a stock will hit bottom, so you don't really want to guess it. Instead of trying to catch a falling knife, it's much safer to let the knife hit the ground, let it bounce up a little bit, like bounce up and down, like with the bouncing, and then after it stops, pick it back up. If it's gone down, if it's gone this high already, how high can it actually possibly go? So if you want to make 10 times your money, you can't sell the stock before it goes up 10 times. But nearly all investors do sell the big winners early because of this faulty logic. The only way to make real money in stocks is by letting them go higher, by not taking that profit early. It's very hard to do, but you have to let your profits ride. It's only $3 a share. What can I lose? What can you lose? If you lose 100%, whether a stock is at $30 or $50, if it falls to zero, it's 100% loss. If it falls to 50 cents, it's not much better. $3 is no guarantee of a bargain. Resist the urge. It's very dangerous. You could still lose it all. Eventually, they'll all come back. WorldCom, Enron, Global Crossing, all the .coms were some kind of fluke. Fact is, they don't always come back. If you catch yourself saying this about one of your stocks, it might be well time to get rid of it. It's always darkest before the dawn. Peter Lynch says sometimes it's darkest before the dawn, but then again, other times it's always darkest before it's pitch black. If you're saying this and you realize it, you want to be absolutely certain that you're not just rationalizing a bad decision. When it rebounds to $10, I will sell it. So when the stock rebounds, they decide that there's nothing wrong with it, and then they keep it. They'll keep it. If it never rebounds, they keep it. The people who do this is that they don't like to admit that they're wrong. So somehow, by holding on to a losing stock, instead of selling it, there's a chance that they'll be right on this laggard. Usually, they're not. If you find yourself in this boat, the best bet is for you to sell your investment immediately. Yeah, so when it rebounds to 10, I'll keep it. Like that. What me worry? Conservative stocks don't fluctuate that much. There isn't a stock on the planet that you can't afford to ignore. Even blue chips can actually get clobbered. This phase justifies the decision to not pay attention to your investments. That's a bad idea. It's your money. It's worth little attention. It's taking too long for anything to ever happen. Well, investors do want action, but think about this. A 12% annual return is about 1% a month. That's a great return, but there's no action. You don't need action, just be patient. As Lynch says, it takes a remarkable patience to hold on to a stock that everyone seems to ignore. Most of the money he makes on a stock, he says, is in the third or fourth year of owning it. Look at all the money I have lost. I didn't buy it. Lynch says this thinking leads people to try to play catch up by buying stocks that they shouldn't buy, if only to protect themselves from losing more than they have already lost. This usually results in real losses. Have you ever made any of these statements or statements like that in the past year of your investing career? Always remember, in the long run, much easier and ultimately less painful to correct a bad decision quickly than it is to continue searching for emotional justification as your portfolio continues to shrink. I missed that one. I will catch the next one. It's better to buy the original company at a high price than it is to jump on the next one at a bargain price. The stock has gone up, I must be right, or the stock has gone down, I must be wrong. Don't confuse the price with prospects unless you are a short-term swing day trader. Like the saying goes, everybody think, so during the bull market, everybody think that they're a genius. But I want to actually flip it and say like during the bear market, people think that they're dumb, like that. And that's the book, One Up on Wall Street by Peter Lynch, right here. And now I'll be closing out this video. And again, the book, I'm going to have the link in the description for you to purchase the book. Okay, this is Dawson's Discussions. My name is Nathan Dawson Jr., and I will see you next time. Take care and have a nice day.